Stellantis stock has a P ratio of 3 and a dividend yield above 10%. But what's interesting is that the stock price is down 53% over the last not even a year. Now things might get interesting from a value investing perspective. And there were many comments. What do you think about the struggling automaker Stellantis? All automakers are now struggling, so we have to dig deeper and see where we are on the cycle, risk and reward from a value investing perspective, because that's what you want if you are here. And I went into the financial statements of Stellantis and all was looking great, high dividend yield, high profits, everything great. And now you dig into the company and you see industrial free cash flow expected to range from minus 5 billion to 10 billion, minus 10 billion from prior positive expectations. Then we look at Q3 2024 shipments and revenues, and the first slide of the presentation is the following. Top line reflects temporary challenges, and these guys will compare the current presentation with the one from February, where, remember this, the stock price was almost at 30, now we are at 13. And that's something that will give us great insight also in the industry, but also in the risk and reward of the investment. The key factors now, net revenues down 27% compared to the prior quarter. That's huge for any company, and that immediately trickles down into profits, into everything. And 27% of revenue decline in one quarter is something huge. But they still try to improve market share. They have made many cars, many new makes, which again costs a lot, but their transition timing impacted by critical realities. Okay, near-term product wave. So with a product wave, yes, you gain market share, but if the market is going down, you don't make much money. And this reminds me of when I was a kid in the Netherlands, my family would watch Good Times and Bad Times, which was a soap back then. But this also reminds me of the automotive industry. So greetings to my Dutch viewers. Goede tijden, slechte tijden. And that's normal for cyclical industries, and we have to see where we are in the cycle to know when it is that great low risk, no risk buy when everything else left is upside. And if we look at Stellantis, it had its good times, it had great times just a while ago, dividends, buybacks, money all over, flushing with money, and now we go from net income of 15 to 17 billion, we go to minus 10 billion. That's the automotive industry, and that's why I really want to go from great times, compare those times, the 2023 full year results with the current Q3 presentation. So record performance, clear transformation progress, everything great, and this, remember the temporary challenges, growth in top and bottom line financial results, and now we have temporary challenges. And going back to 2023, industrial free cash flows 13 billion. Now if they get minus 10 billion, then you understand why those companies, even when times are good, look cheap with P ratios of 3, because at the end 12 minus 10 is just 3 over 2 years. That's 1.5 over a year. And they use that money to return to shareholders, buybacks, whatever, investing a lot into a lot of new makes to gain market share. And all of those companies also invested in electric vehicles. So everything looked great, net revenues looked stellar, margins looked great, industrial free cash flows great, number of shipments that are now an issue for inventories were also up. And just look at the great times last year, and now we are in bad times. So more cash, everything was great, capital allocation, open market buyback program, dividend going higher, and everything looked great. And the margin, the guidance was for double-digit minimum commitment margin, so everything was great. positive cash flows despite the investments. The electric portfolio to expand 60% to 48 cars in 2024, and this was all on the electric bubble. But what happens when there is a growing market? Then every automaker invests, and then the market goes down. This is with China. The market actually goes down, and now we have all these companies coming in with huge number of new cars, chasing a market that isn't going up at 30%, but is going down at 10, 20, and then will stabilize again. Most of these things always revert to some kind of mean. So you have ups and downs and ups and downs. And that is the essence of cyclicality that I wanted to focus in this video. And now they are resetting, preparing for an improved 2025. Do you remember the guidance of great times in 2024? And now, sorry, we were wrong. Margins, we go from positive to 10 billion down because temporary challenges. So we cannot know, because I'm looking at this. The US economy is doing great. It's robust. So cars and everything should be doing great. Europe is still in the positive, which is a surprise. I don't know how they are managing that, but okay. And Goldman Sachs is cutting the probability of US recession to just 15%. But car stocks are in the toilet, people of mine. That is something very surprising. Then I dig deeper into the financials. Stellantis has some debt. If this is all the debt that they have compared to the cash flows, they have net positive financial position, but they are going to spend that all in the car makes. And if you take 10 billions out per year, the cash is gone in a year, which is then a risk. So they can survive 2 years. The industrial free cash flows are now negative, will likely go lower. But if I look at the balance sheet, they have 200 billion of assets, but they also have a lot of intangible assets. Here we are, 52 billion of intangible assets. Compare that to the equity of 82 billion. So the equity is then again around 30 billion, the real equity, which then again explains the market cap of, this is in euros, so $40 billion, something like that. So it is interesting. There are these provisions for warranties that they will have to pay. When times are good, it looks good on the net income, but when times are bad, it doubles down 2 times on the net income. The debt is there, not as crazy as with others, so we'll see how the market evolves. But there are also other liabilities. They also said they will do those buybacks. So when it comes to Stellantis, the key risk here is, what if these aren't temporary challenges? What if we are going into a bad end of 2025? Then we have 10 billion down, 10 billion down, and then if it doesn't recover in 2026, then we are 40 billion down, and then we go another 50% down. So that's the risk with automakers. Yes, Goldman Sachs cuts the probability of a recession, but automakers, with all the new makes that they are making, everybody, with all the huge investments that they threw in from 2020, when those electrical cars were going up like crazy, compare that to AI. So when we had the green electrical bubble, now we are seeing mean reversion, which is normal of any bubble, and will happen also to the other bubbles that we are now. And this is how it looks like when it gets reverted. So we are there, all companies have invested like crazy, and now the bills come due. And when the bills come due, the good, the merger, the everything looks great. But when bills come due, we have a few years of ugly, depending on the cycle, depending on customer preferences. And yes, now it looks cheap with a P ratio of 286, with a price to book value that is extremely cheap. That is not really price to book value, because when you deduct the intangibles from the mergers, it is around 1, but the dividend yield is high. They will likely cut it if they have more, let's say, downturns. So interesting. I still think we are at mid-cycle. So if there is a recession, wake me up and we'll check again all the automakers. If not, there will be ups and downs as the market evolves, as the capacity for electrical vehicles get absorbed by the market, even if there has been a drop in demand, significant drop, not in China. But when it comes to these companies, wake me up when we have a proper recession, higher interest rates, and then everything freezes in the market. Still, despite the 50% down, we are still at now. We were a year ago at high risk, very low reward, because it was clear that the cyclical will invert. We are now at mid risk, mid reward, and then we need a recession next year for low risk, high reward. Thanks for watching. I'll see you in the next video.